everyone, and welcome back. Today, we're diving into a fascinating financial story, one that might seem a little backwards at first glance. Imagine a company that's reporting lower overall revenue, yet somehow it's managing to increase the cash it pays out to its shareholders. Sounds like a magic trick, right? But it's not. It's a strategic pivot, and it's happening with OUE REIT, a big player in Singapore's real estate scene. We're going to break down OUE REIT's first half of 2025 performance. We'll look at the good, the challenging, and what it all means for its future. So stick around because this story reveals a lot about smart financial management. First, let's tackle that head scratcher. How did they boost shareholder payouts, officially known as distribution per unit? Well, for the first half of 2025, OUE REIT reported a DPU increase of 5.4% year-on-year, with their core DPU, excluding special payouts, climbing an even more impressive 11.4%. This is fantastic news for investors seeking income. The secret sauce here? Proactive capital management and a significant reduction in financing costs. Think of it this way. Even if the money coming in from rent declines slightly, the cost of borrowing money for the properties dropped even more. Their financing costs actually fell by a whopping 17.3% year-on-year in the first half of 2025. This was largely thanks to a declining interest rate environment in Singapore. A huge part of this financial efficiency comes from a major strategic move. OUE REIT sold off its only overseas property, Lippo Plaza Shanghai, in December 2024. The money from that sale is being used to pay down debt. This move is expected to lead to even more interest savings in the future and significantly lowers their overall debt burden. It's like shedding a foreign currency risk and getting leaner and meaner financially. And this brings us to OUE REIT's new identity. They are now a pure play, 100% Singapore-based REIT. Their portfolio is entirely concentrated on 6 key assets right here in Singapore. We're talking about top-tier hotels like the Hilton Singapore Orchard and Crowne Plaza Changi Airport, plus prime office spaces in the Central Business District and the swanky Mandarin Gallery retail mall. Now, let's look at how these assets are performing, because it's a bit of a mixed bag, a tale of two segments, if you will. On one side, we have the commercial segment, offices and retail, absolutely shining. This part of their portfolio is a rock-solid performer. Their office buildings maintain incredibly high occupancy rates, consistently above 95%, showing strong demand for prime office space in Singapore's CBD. When office leases were renewed, OUE REIT saw positive rental reversions of over 9%. That means they're commanding higher rents for their spaces. Mandarin Gallery, their retail mall, is almost fully occupied and saw an incredible 34.3% positive rental reversion in the second quarter of 2025. That's demand speaking right there, especially for prime Orchard Road retail. The strong performance of their Singapore commercial assets truly acts as a crucial stabilizer for the entire REIT, cushioning any bumps from other segments. On the flip side, their hospitality segment has faced some challenges. Revenue and net property income from hotels saw declines in the first half of 2025. This is partly due to a tough comparison against 2024, which had exceptional factors like the China-Singapore visa-free arrangement and a packed calendar of major concerts. Specifically, the Hilton Singapore Orchard experienced a moderation in its revenue per available room. Why? Well, there's been an increase in hotel room supply in the Orchard area, leading to more competition. Management also noted factors like fewer U.S. corporate travelers, a shift in Chinese tourist demographics, and a decline in Indonesian tourists. But it's not all doom and gloom in hospitality. The Crowne Plaza Changi Airport, for example, actually showed robust performance, with its revenue per available room increasing. Its proximity to Changi Airport and Jewel Changi Airport definitely helps. And there's cautious optimism for the hospitality segment going forward. Singapore has a strong pipeline of major events coming up in 2025, including Lady Gaga concerts and the Formula One week with Elton John. These events, combined with projections from the Singapore Tourism Board for increased visitor arrivals, could provide a much-needed boost. So with this mix of strong commercial performance, a strategic portfolio shift, and a challenging but potentially recovering hospitality segment, what are analysts saying? Well, despite the headwinds, most financial analysts have maintained a buy recommendation for OUE REIT. They see the stock as undervalued compared to other similar Singapore REITs. For example, OUE REIT is trading at about 0.54 times its price to net asset value, while some peers are closer to 1.0 times. This suggests there's potential for its share price to climb as the market fully recognizes its de-risk profile and improved financial efficiency. Plus, it offers an attractive forecast dividend yield of around 6.4% for 2025. This makes it appealing for income-focused investors. And here's a really interesting point. While the broader Singapore REIT sector has seen institutional investors pulling out some money, OUE REIT's own sponsor and key insiders have actually been increasing their stake. This shows a strong vote of confidence from those closest to the company's strategy and assets. It suggests that despite what the overall market might be doing, the people who know OUE REIT the best are confident in its direction and long-term prospects. In summary, OUE REIT is undergoing a significant transformation. They've boosted DPU through sharp financial management and a focused debt reduction strategy. Their Singapore commercial portfolio is a rock-solid income engine, and while hospitality faces hurdles, there's a clear path to recovery with major events on the horizon. The strategic shift to a purely Singaporean focus has de-risked the company, and analysts see it as undervalued with strong potential. Now, here's the really important part. Important disclaimer. This video is for informational purposes only and is not a financial recommendation to buy or sell OUE REIT. Investing in real estate investment REITs or any financial instrument carries risks. Markets can be unpredictable, and past performance is not indicative of future results. Always do your own thorough research, consider your personal financial situation, and if you're unsure, please consult with a qualified financial advisor before making any investment decisions. So what do you think? Is OUE REIT's strategic pivot enough to secure its long-term growth, or are the hospitality headwinds too strong to ignore? Let me know your thoughts in the comments below. If you found this breakdown helpful, please give this video a thumbs up and subscribe for more insights into the financial world. Thank you for watching, and I'll see you in the next one.